Gold just flashed a danger signal, and nobody is talking about what comes next. Gold has just confirmed a pattern. That has appeared only twice in the last 15 years. Both times it appeared, what followed was not stabilization. What followed was not recovery, and this time, gold had already fallen 28% before the signal even showed up. But here is what almost no one is saying. Buried inside the very same data that triggered this signal is a second signal, moving in the exact opposite direction, and that second signal does not just complicate the picture, it changes the ending entirely. Welcome to John AG. If you have been following this channel for some time, you already know what happens here. No noise, no guesswork dressed up as certainty, just the data, the patterns, and the honest analysis, delivered before a decision gets made that cannot be undone. Now, if you are not yet subscribed, let me put it to you the way one trusted friend puts something to another. You would not sit through an important conversation with someone you respect and then walk away without making sure they could reach you again. Hit that subscribe button. Think of it as saving a number in your phone, the number of someone who will always call you before something serious moves in the gold and silver markets. And before we go any further, drop your location in the comments right now. Your city, your country, your time zone. Tell us where you are watching from. This channel reaches serious investors on every continent at every hour of the day. Every time someone shares where they are, it helps this analysis find one more person who needs to hear it. Now, let us talk about what just happened. On the morning of June 29, 2026, a signal confirmed on the gold chart that technical analysts and algorithmic trading systems across global financial markets had been watching build quietly for weeks. It did not arrive with the sudden violence of a market crash. It did not come attached to a breaking headline or a geopolitical emergency. It arrived the way the most consequential financial signals almost always do, patiently, methodically, through the slow convergence of two lines on a price chart that had been drifting toward each other for months. The 50-day moving average of gold's price crossed below the 200-day moving average. In the language of technical analysis, this is called a death cross. And it had not appeared in gold since the major correction that began in the summer of 2022. By the time that pattern confirmed on June 29th, gold had already erased 28% of its value from the January 2026 all-time high of $5,589 per ounce. The metal that had commanded extraordinary institutional excitement just 6 months earlier, the asset climbing towards $6,000 while major bank analysts competed to raise their price targets, was now sitting near $4,120. It had just posted its worst quarterly performance since the second quarter of 2013. For the millions of investors who had entered the gold market during its historic 2025 and early 2026 ascent, those who had read the forecasts, trusted the analysis, and committed serious capital to physical gold, ETFs, and mining positions, the death cross confirmation felt, to many, like the final verdict being handed down. Technical momentum, broken. Short-term trend, now below the long-term trend. Every algorithmic system watching the market, reprogrammed to treat gold as a sell, the conclusion forming in trading rooms, financial forums, and quiet living room conversations from Arizona to Australia sounded almost identical. The death cross had confirmed, the signal was clear. Exit the position before the next leg lower begins, and then, 48 hours later, everything changed. On July 3, 2026, the United States Bureau of Labor Statistics released the June employment report. The headline number, non-farm payrolls, showed that the American economy had added just 57,000 jobs in the month of June. Economists had been expecting somewhere between 110,000 and 114,000. 57,000 was barely half of that. Unemployment ticked upward to 4.2%. Private payroll growth came in softer than forecast. And within hours of that single report landing, the probability of a September Federal Reserve rate hike, tracked in real time by the CME FedWatch tool, dropped sharply from 66% to between 53 and 54%. Gold responded immediately. Prices moved from $4,120 on June 30th to $4,175 by July 3rd. By July 4th, the price had pushed further still to $4,187 per ounce, a 2.5% rally in 48 hours, gold's first weekly gain in 5 consecutive weeks. The death cross was sitting on the chart, confirmed, visible, being cited by every major financial news outlet, and gold was rising anyway. Now here is the detail that separates a serious investor from a reactive one. two signals confirmed within 48 hours of each other, one of the most bearish technical patterns in modern market history, and one of the most powerful fundamental economic releases that gold could have received. Both confirmed, both real, both pointing in completely opposite directions. And the mainstream financial media, in its rush to explain the death cross, had missed something entirely. The danger signal in the gold market right now is not the death cross. The danger signal is that most investors are only looking at the death cross. Because hidden inside the same data that produced this bearish pattern is a second signal, one that will determine whether what just unfolded is the beginning of gold's greatest buying opportunity since 2016, or the start of its most brutal leg downward since 2013. Both outcomes are mathematically possible right now, and the difference between them comes down to a single question that has nothing to do with moving averages, chart patterns, or technical models. It has everything to do with what 57,000 jobs just told the Federal Reserve, and whether the Federal Reserve is listening. There is a man in Arizona. His name is David. He is 58 years old. He has spent 30 years building a business, raising a family, and making careful, disciplined financial decisions. He is not a speculator. He is not chasing quick returns. He is the kind of man who reads before he acts, who asks hard questions before committing capital, and who measures risk the way a serious person measures everything else, slowly, honestly, without the comfort of wishful thinking. In early 2025, David made his most significant financial decision in a decade. He bought gold. His first allocation came in at approximately $4,500 per ounce. By late 2025, as every major institution and analyst appeared to be racing toward the same conclusion, that gold was heading to $6,000, possibly beyond. David added more. His second purchase came near $5,000 per ounce. At the January 2026 all-time high of $5,589, David was sitting on a paper gain of more than 20%. He did not sell. He had read the forecasts. He understood the thesis: central bank buying at historic levels, geopolitical instability compressing trust in fiat currencies. The Federal Reserve locked in a cycle that, in David's reading of the data, made another leg higher in gold not just possible, but probable. $6,000 seemed conservative. He held, and then gold began to fall, first slowly, then with increasing velocity. By late June 2026, gold had broken below $4,000. David's 20% paper gain had quietly, steadily dissolved into a small but real loss. The kind of loss that does not destroy a portfolio, but the kind that sits in the mind of a careful man and does not leave. And then, on June 29th, he read 3 words that he had been hoping would not appear: death cross confirmed. David had heard those words before. He had been watching markets long enough to remember 2013. In early 2013, gold had already been falling for over a year. The metal peaked in September 2011 at just over $1,900 per ounce. Through 2012, it did not collapse. It simply ground lower, slowly, quietly, in a way that made long-term bulls feel their conviction was being tested rather than broken. Then, in early 2013, the 50-day moving average crossed below the 200-day moving average. The death cross confirmed. Within weeks, gold broke from approximately $1,600 to below $1,200 by the summer. A collapse of more than 25% in months. The death cross had not predicted that collapse. It had confirmed that the collapse was already fully underway, and that the worst of it was still ahead. The 2022 pattern followed the same script. Gold peaked in March 2022 at just over $2,000. The death cross confirmed in July. The metal continued falling through the autumn. The pattern did not arrive at the beginning of the decline. It arrived in the middle of it after the easy money had already been made on the short side, and after enough long position holders had been lulled into believing the worst was behind them. That is what makes the 2026 death cross particularly significant. It did not confirm at the beginning of gold's decline. Gold had already fallen 28% before this signal appeared, and historically, this is the detail that matters most. A death cross that forms during an already established downtrend carries a fundamentally different implication than one that forms at the early stages of a correction. When the signal confirms late, it does not mean the decline is nearly over. It means the decline has gathered enough momentum to overwhelm the long-term average, which is precisely when the next leg tends to be the most violent. David knew all of this. He sat with the chart open on his screen. He read the history. He ran the numbers from 2013 and 2022. He understood what the pattern was saying with cold, technical clarity. And then, on the same day, he was preparing to make the most difficult financial decision of the last decade. His phone buzzed. A market alert. Gold was rising, not modestly, not a technical bounce off a minor support level, a genuine 2.5% move in 48 hours. And the reason it was rising had absolutely nothing to do with the death cross. It had nothing to do with chart patterns, moving averages, or any technical model David had been studying for the past 3 weeks. It had to do with a single number, 57,000, a number so far below expectations that it had just forced the most powerful financial institution in the world to quietly reconsider everything. David stared at his screen. The death cross was still there, confirmed, visible, sitting on the chart exactly where history said it should be, pointing downward toward lower prices, toward the kind of outcome that had played out in 2013 and 2022. But gold was not going down. It was going up. And David, careful, disciplined, 30 years of measured decisions behind him, had no idea which signal to trust, because for the first time in his investing life, both signals were telling the truth at the exact same moment, and only one of them could be right. There is something that serious investors understand about financial markets that casual observers almost never do. Markets do not move on what happens. They move on what happens, relative to what was expected. On July 3, 2026, what happened was this. The United States Bureau of Labor Statistics released its June employment report. The headline figure, tier, non-farm payrolls, showed that the American economy had added 57,000 jobs in the month of June. The expectation had been somewhere between 110,000 and 114,000 jobs. 57,000 was not a mild disappointment. It was not a modest miss that analysts would round up and explain away by Friday afternoon. 57,000 jobs was barely half of what the most conservative forecast had projected. And in the precise mechanical world of Federal Reserve policy and interest rate expectations, a number that far below consensus does not create uncertainty. It creates a reversal. To understand why that single employment figure hit the gold market with such immediate force, it is necessary to understand one of the most important relationships in modern financial analysis. Gold does not pay interest. It generates no yield. It produces no dividend. It issues no quarterly earnings report. In a world where government bonds pay 5% and high-yield cash instruments return 4%, holding gold carries what economists call an opportunity cost, the cost of what you give up to hold an asset that produces nothing. When the Federal Reserve is raising interest rates, or when the market believes it is about to, that opportunity cost rises, bonds become more attractive, cash becomes more attractive, and gold, which offers none of those returns, becomes less attractive by comparison. Institutional capital rotates out, prices fall. But when the market begins to believe, based on hard data, that the Federal Reserve may be done hiking rates, or that it may be forced to pause because the economy is slowing faster than its models anticipated, that opportunity cost begins to fall, and gold begins to look different. That is precisely what 57,000 jobs communicated to the market in real time. A number that weak does not describe a thriving economy. It does not describe an inflation environment that demands continued aggressive monetary tightening. It describes an economy showing genuine signs of deceleration, the kind that historically forces central banks to reconsider their next move. Within hours of the report's release, the probability of a September Federal Reserve rate hike, tracked in real time by the CME FedWatch tool, dropped from 66% to between 53 and 54%. That is not a minor adjustment. That is a fundamental repricing of the policy environment that gold trades within. Gold responded immediately. From $4,120 on June 30th, prices climbed to $4,175 by July 3rd. By July 4th, the price had extended further to $4,187. Gold's first weekly gain in 5 consecutive weeks. OCBC strategists, in a note released shortly after the employment data landed, described their outlook as cautiously constructive. Not bullish, not aggressively optimistic, cautiously constructive. It was careful, deliberate language, the kind used by analysts who see a genuine improvement in the fundamental picture but cannot ignore the technical damage still sitting on the chart. It was, in 3 words, a precise description of the exact tension that David was living through in real time. And then silver moved. This is the detail that almost every mainstream analysis of this moment missed entirely. While gold posted its 2.5% gain over 48 hours, silver moved from approximately $58.30 per ounce to more than $62.40. That is a move of 6 to 7% in the same window, on the same data, in the same market. Silver outperformed gold by a factor of 3 to 1. The gold to silver ratio, the measure of how many ounces of silver it takes to purchase 1 ounce of gold, tightened sharply from above 70 down to 66.9. And that ratio is not a footnote. That ratio is a confession. In precious metals markets, gold and silver do not always move together for the same reasons. Gold is primarily a monetary metal. Its price responds to fear, to inflation expectations, to central bank policy, to currency debasement. When investors flee to gold, they are fleeing towards safety, away from risk, away from uncertainty, toward the oldest store of value in human financial history. Silver is different. Silver carries that same monetary identity, but it also carries something else entirely. Roughly half of all silver demand comes from industrial applications: solar panels, electric vehicles, semiconductors, medical devices, electronics. Silver sits at the intersection of monetary preservation and industrial growth in a way that no other precious metal does. When gold leads a rally and silver lags, the market is saying something specific. It is saying, this is a flight to safety. Investors are scared. They are moving toward the most defensive asset in the complex. But when silver leads a rally, when silver outperforms gold by 3 to 1 in the same 48-hour window, the market is saying something completely different. It is saying the worst-case scenario is being priced out. It is saying, we no longer believe the Federal Reserve is going to tighten this economy into a hard landing. It is saying, industrial demand will survive. Green energy investment will survive. Technology infrastructure will survive. Silver's 3 to 1 outperformance was not noise. It was the precious metals market telling anyone willing to listen that the jobs data had just removed the most extreme bearish scenario from the table. David understood this. He had done his reading. He had tracked the ratio. He saw the silver move before most people had even opened their trading platforms that morning. And for a brief, clarifying moment, sitting at his desk in Arizona, coffee cooling beside him, 2 contradictory signals staring back from his screen, something shifted in his thinking. The death cross was still there, confirmed, real, historically significant. But silver's behavior had just revealed something that the gold chart alone could never show. This was not a flight to safety rally. This was a risk-on move inside the precious metals complex, and risk-on moves do not happen in markets that are pricing in collapse. David leaned back. For the first time in 3 weeks, the picture was beginning to clarify, but then he made the mistake that even experienced investors make when relief arrives after a long period of anxiety. He assumed the clarification meant the danger had passed. It had not, because what was coming in the next 30 days was not a resolution of the 2 signals that had been pulling in opposite directions. What was coming was a third signal, one that neither the death cross nor the jobs data had prepared anyone for. David did not sleep well that night, not because he was panicking, not because his portfolio was in crisis, but because he was a careful man. And careful men do not rest comfortably when 2 contradictory signals of equal historical weight are sitting unresolved on their desk. The death cross said, the worst is still ahead. The jobs data said, the worst may already be behind us. And silver's 3 to 1 outperformance had confirmed that the market itself could not decide which story to believe. So David did what serious investors do when the present moment offers no clean answer. He looked forward. He asked a different question entirely. Not which signal is right, but what is coming that will determine which signal wins. That question leads directly to the third signal. And unlike the death cross, which arrived on a chart, and unlike the jobs data, which arrived in a government report, the third signal had not yet arrived at all. It was still in the future. Specifically, in the 2-week window stretching from early to mid-July 2026. Inside that window, the market was preparing to receive updated inflation data, the June Consumer Price Index report. Retail sales figures, additional employment data points, and perhaps most critically, commentary from Federal Reserve officials responding directly and publicly to the June jobs miss. This data window is not background noise, it is the verdict. Because here is what almost no financial outlet covering the death cross had reported. Oil prices, the single largest driver of the headline inflation numbers the Federal Reserve had been citing to justify its hawkish stance, had already collapsed significantly from their earlier peak levels. The CPI data that shaped the Fed's most recent policy posture was calculated using energy prices from weeks prior. The June CPI report, due in mid-July, would be the first inflation print to fully reflect where oil actually was right now. And if that number came in softer than the market expected, The Fed's entire justification for continued rate hikes would be standing on sand. This is the binary that David Dees and every serious gold investor now faced with absolute clarity. If the incoming data confirmed what 57,000 jobs had suggested, that the economy was genuinely slowing, that inflation was cooling faster than the Fed's models acknowledged, that a September rate hike was becoming less defensible by the week, then the death cross would become what bears had never expected it to become: noise. A technical pattern that confirmed at precisely the wrong moment, a bearish signal that arrived just as the fundamental environment was quietly, decisively turning in gold's favor. Gold's resistance at $4,200, the level where the market had stalled repeatedly through late May and early June, would become a floor rather than a ceiling. The next target above that, $4,300, where the 50-day moving average was likely positioned by mid-July. A reclaim of that level would be the first technical confirmation that the death cross was losing its grip. But if the data told a different story, if the June CPI came in hot, if retail sales held strong, if additional employment prints revised the June miss upward, and if Federal Reserve officials signaled clearly that one weak jobs report would not change their tightening path, then the death cross would become exactly what it had been in 2013 and 2022. Dominant. The 2.5% rally would be reclassified, not as the beginning of recovery, but as a bear market bounce, a temporary exhale inside a larger, longer decline. Gold support at $4,000, the level that had held through late June with meaningful physical buying from markets like India, would face a test it might not survive. Below 4,000, the next meaningful floor sat between $3,800 and $3,900, and below that level, the risk of a move toward $3,500 became mathematically real. For silver, the same framework applied with sharper edges: resistance at $65, then $70, support at $58, then $55. And below 55, the kind of move that rewrites the narrative entirely. David understood all of this. He built the framework. He mapped the levels. He tracked the data calendar. He did everything that a disciplined, serious investor is supposed to do. And then he encountered the one insight that changed his entire approach, not to the trade, but to the question itself. It came from a perspective he had almost dismissed. Peter Schiff, the economist and gold advocate who had spent decades arguing that gold's true performance could only be measured across decades, not quarters, made a point in late June that stopped David mid-sentence when he read it. Schiff noted that gold had risen from below $300 per ounce in 1999 to over $4,000 today. Not in a straight line, not without death crosses, bear markets, brutal corrections, and years where every technical signal pointed down and every mainstream analyst declared the bull market finished. But across 25 years, through every signal, every pattern, every binary outcome tree, the direction had been singular. And then Schiff asked a question that David had never thought to ask himself. What time frame are you actually investing on? This is where David's story reaches its most important moment. Because David realized, sitting at his desk, chart open, data calendar beside him, that he had been asking the wrong question since June 29th. He had been asking, which signal do I trust? The real question was, which signal is relevant to the time horizon I actually have? For a short-term trader, the death cross mattered enormously. Technical damage was real. Momentum had shifted. The risk of another leg lower toward 3,800 or 3,500 was not theoretical. It was historically supported. For a long-term holder with a 5 to 10-year horizon, the death cross was a chapter in a much longer book. Central bank buying continuing at historic rates, geopolitical instability eroding confidence in fiat currencies, U.S. national debt compounding past levels that gave the Federal Reserve far less room to hike than its public statement suggested. For someone with fresh capital, waiting on the sidelines, the next 30 days of data was the only guide that mattered. Not the death cross, not the jobs report, the inflation print, the retail numbers, and what the Fed said publicly in response. 3 different investors, 3 different correct answers, determined entirely by time horizon. The danger signal in the gold market was never only about the death cross. The real danger signal was the one David almost missed entirely. It was the signal that appears not on a price chart, not in a government employment report, not in a ratio between 2 metals, but in the gap between what an investor believes their time horizon is and what their actual behavior reveals it to be. David had told himself he was a long-term holder, but he had been checking the gold price every 4 hours for 3 weeks. That gap, between stated conviction and actual behavior is where serious financial decisions go wrong, and closing that gap is the one move that no chart pattern, no jobs report, and no Federal Reserve policy decision can make for any investor. That is a decision that belongs entirely to the person holding the position. Quick question, and this one matters. Did you know the death cross had confirmed on June 29th before watching this video? And did you know that gold had already staged a 2.5% rally in the 48 hours that followed? Type yes or no in the comments right now, because the answer tells a story about how much of this information is actually reaching the people who need it most, the serious investors making real decisions with real capital in real time. And one more thing. Where are you watching this from? Your city, your country, the time on your clock right now. This channel reaches investors from every corner of the world, and every time someone drops their location in the comments, it helps this analysis find one more person sitting with the same questions David was sitting with. If this video gave you something genuinely useful today, a framework, a number, a perspective that clarified something that had been blurred, hit the like button right now. It is the single most powerful way to ensure this analysis reaches the next serious investor who needs to hear it before a decision gets made that cannot be undone. This is John AG, and the gold market is still speaking. The only question left is whether you are positioned to hear it.